Analysts are predicting that fixed deposit interest rates in India will remain high for an extended period. This is due to strong credit growth, tight liquidity, and fierce competition for funds. Both large and small banks have raised their term deposit rates in order to secure funds to meet credit demands. Last week, the State Bank of India (SBI) increased its fixed deposit rates in select tenures by 25 to 50 basis points. SBI is also offering a special 7.10% deposit rate for a 400-day tenure, valid until March 31, 2024. 1 basis point equals 0.01 percentage point. Similarly, Kotak Mahindra Bank has raised interest rates on certain fixed deposit tenures above 3 years by 50 to 75 basis points. Meanwhile, DCB Bank, a smaller lender, has increased its fixed deposit rates by 10 basis points to 7.85% within the 12 months 1 day to 12 months 10 days tenure. It also offers 8% for 25 to 26 months. Analysts have stated that banks are compelled to increase deposit rates due to tightened liquidity in the banking sector and increased competition for deposits. People now have alternative investment avenues, which has led to banks needing to offer higher rates to attract deposits. Although deposit growth has improved, it still lags behind credit growth. Initially, banks expected deposit rates to soften by the fourth quarter of this fiscal year. However, it is now expected that these rates will remain high for a longer duration, according to Mona Khaitan, Vice President Research at Dolat Capital. The banking sector liquidity has shifted from a surplus of around 2.5 lakh rupees crore in early August to a deficit of 1.2 lakh rupees crore after the government's withdrawal of 2000 rupees banknotes. The latest data from the Reserve Bank of India (RBI) shows that credit growth has eased to 15.8% year-on-year from 17.4% last year, but it still exceeds the 13.3% growth in deposits. Analysts suggest that due to robust credit growth, banks will continue to make efforts to gather more deposits. Nitin Agarwal, an analyst at Motilal Oswal, expects deposit rates to remain elevated at least until the fourth quarter of the current fiscal year, as this period experiences high credit demand. However, the specific tenures and rates offered will be at the discretion of individual banks. Agarwal further predicts a 5 to 10 basis point year-on-year decline in margins for public sector banks and a 10 to 20 basis point easing in margins for private sector banks, mainly due to their reliance on term deposits. With no signs of credit growth easing, analysts anticipate that the banking system's loan growth will hover around 15% in the next fiscal year. This scenario will compel lenders to either continue offering higher rates to attract deposits or to curtail loan disbursals altogether, they say.